Okay. Looks like we're live. Welcome everybody to Midas Investing Live. In a few weeks. Hope you guys have had a good however many weeks it's been since we've done a show. Let's see here. Audio looks good, connection looks good. Okay. Got a handful of things we'll talk about today. We'll see how long the show goes for. Happy President's Day to anybody in the United States that celebrates, or George Washington's birthday for that matter. Um, but yeah, U.S. markets closed today. Otherwise, they'd be open right now. But good day to get a bunch of research done if you're off from work like I am. Uh, by the way, and before we get into it, I'll try to remember, as I've usually been pretty bad about a lot lately. But if you're watching either live or on the replay, please do like the stream. It'd be really, really appreciated. It really helps attract more viewers to the channel. Subscribe to the channel if you're not already. Hit the notification bell and all that. You can also hit the link in the chat, as well as it should be the pinned comment in the description below. But the link to the Discord, which you can come and join, be part of our Discord, where we have discussions of what's going on in the markets every day, what's going on in our own portfolios, ideas we've got of what we might do for various investments, discussions of what other investors are doing throughout the markets and stuff like that. So come be part of our Discord. It is free. However, there is a gated opening. So when you first click the link, it'll look like an empty landing page, and you do have to be patient and either wait like 24 hours or so for somebody to let you in, or you can usually see the mods on the right hand side, and you can maybe pester one of them or me to let you in a little bit quicker. But we do have a little bit of a screen there for bots. Either way, it is free to join, so feel free to join that. And if you want to support the channel in any other way through PayPal or through YouTube or through anything else, any of the above, Patreon, all the links are below as well. So consider that as well. So anyway, shilling done. Usually try to get that done at some point in the stream. Usually kind of bad about it. So you can see my portfolio here as usual up front. There has been some changes, I think, since the last time we chatted. For the first part, there has been a huge cut to our miners position. I can't remember exactly what it was at previously when we last discussed it, but the miners are currently down to, let's see, what is the total size here? It's now 7.5% of our portfolio. I definitely think it was well above that. I'm pretty sure it was like 60, almost 70% of our total miners positions, or it might have been like 70% of our total gold and miners positions at that time when I did it. But I was also overweight gold relative to the normal weight I have in my macro allocation system, and so at the exact date when I made that sale, so it's kind of hard to differentiate which part of that was the gold sale versus the miners. Because as you can see here, I have 16% of my portfolio in gold right now, and this represents usually kind of being in that overweighting kind of position. So the point is a little hard to differentiate between that. But either way, now down to 7.5% here. It was either way. Like I said, it was at least twice as much as that, if not three times as much as that. I can't remember exactly where the percentage topped out about. But it was a really, really well timed sale, I think. Very, very well done. And, I had held those positions for quite a long time. So it was like here, let's see, waited 1 year for Equinox, 1.6 years for Silvercorp, 1 year for Orla, 1.1 year for New Gold. And that's money weighted. So it doesn't really take into account like when I made my first purchase. If it reached those, it might have been like a year earlier, depending on how much I had been adding to it over time. But up very, very, very much, 150% almost for Equinox, almost 250% for Silvercorp, 130% for Orla, 250% for New Gold. I had weighted them all together, and it was like well over 100% on an annualized basis for all four of them weighted together, as it currently stands. And I'm still holding the position. In fact, I'm still believe I'm overweight still relative to what my targets are for those positions. In fact, if we come over to my watch list and highlight the same companies, we could see exactly what the target size would be. Okay, not too much over, because right here it says that my target size would be 7.27%. Although it's worth noting that like the targeting system over the weekend can be a little bit weird because of the way that some of the features of how the targeting works doesn't really work super well when markets are closed because it involves certain momentum signals in there. So it could be that some of those are slightly off, but either way, it's in the ballpark. It's in the ballpark. We're like maybe slightly over our allocation for those mining positions. When before we were like twice that position size, three times that position size. All in together, those were easily our largest position previously. So it was a huge amount of gains captured in both in like just dollar amount, just like sheer dollar amount terms, and also in terms of percentage of my portfolio. It was the single largest sale and capture of profits I've actually ever had. I've sold positions that in like total size, total allocation size were that large in my portfolio, like up over 25% of my portfolio sold at a time, but not as much of that 25% was profit, right? Or, whereas in this case, it was like two-thirds of that was profit. So it was the single largest percentage of profit captured at one point in time in my portfolio, and also, like I said, in also just sheer dollar terms as well. So very, very cool, very, very cool. Long time coming in terms of capturing on that sale. I've been talking about miners my entire investing career, which I started doing individual investing in 2018, and I've been talking about it as long as I've been on YouTube, which has been since 2021. So yeah, I do think that obviously, anybody who's been paying attention to me knows that I've been talking about miners. Although how much I've been allocated into in my portfolio has moved up and down throughout those periods. And so, really, as could be indicated by those money weighted terms being roughly around a year or like a year and some change, that kind of gives you the indication that I essentially had re-weighted and reallocated hard into the miners at the end of 2024, or I should say, like through the second half of 2024 through the first quarter of 2025, like that kind of 9 month window there, I had been aggressively reallocating to miners, and obviously that paid off very, very, very well. So yeah, that's definitely the biggest change that's happened in the portfolio. And also, like I said, the timing of it was really, really cool, and that kind of gets back to kind of just the overall macro strategy I've developed, and also like the momentum tools, because like just looking at like what happened with gold, the timing of it was kind of like fascinating. I believe my system uh, had reallocated into kind of an overweight position here on this particular Tuesday, which was after a 3 day weekend, and so it was kind of captured half of this candle, had moved up through this, and then it had decided that it was going to sell back down to the normal weighting position here on this Monday, right here, and that was also the Monday I chose to sell a massive portion of my miners. So it was like just super luck on my part that I was managed to bypass all this, but I did sell like two-thirds of my miner positions on this Monday. A few days later, it had shot up a little bit more, and then we came back down. And if I was to like layer on the actual miner positions, obviously they would have varying performances since then. And like as you see with gold, it came back down to kind of this level, and it's kind of somewhat stabilized since then. Silver has done a little bit less strongly. It's kind of still stabilized, but it's kind of doing a little bit of a somewhat downtrend. So we'll see what's going on with that. It wouldn't shock me if maybe this was actually sort of the actual end in terms of these heights for silver, and maybe like it came down to here for like a few years or something like that. I have no idea. If it came back up, it also wouldn't surprise me either. Well, the point is, in terms of like the short to medium to long term kind of transformation for what happens with silver, I don't have as specific of an opinion. Whereas with gold, um, uh, I actually do have a stronger kind of belief that this really was just like a correction, and it very well could continue upwards. It also could be it for gold as well, but to be honest, but the point is there's a lot more sustainable structural reasons why the price action is what it is. But anyway, and it's worth noting that, like I said, the macro system allocation had taken me out of my overweight of gold on this Monday right here. But it also then brought me back in on this Monday right here, and then I think I got back out on this Monday right here. So that trading system worked like a charm around this particular volatility event, but that's not here nor there. That's been pretty great. And obviously it has a variety of other positions in various sector ETFs as well as country ETFs, which I know I commented on in one of my previous streams. I was talking about like how much it really did. There were so many articles and stories going around the kind of financial press about the broadening out of the market and the kind of rotation of money from some of the larger cap positions into the rest of the market. As you can see right here, like it seems like the market's been kind of struggling a little bit in the last few months to really kind of take new heights, just kind of struggling along here sideways, which is better than it kind of crashing down. And that seems to be what's happening, is that the market is managing to kind of go sideways while some of the larger positions have been coming down, and then money's been spreading out to the rest of the market. And I had been talking about how I kind of see that in my little macro strategy system, because it had been putting me into more and more different ETFs, whereas like most of last year it was like one or two sectors at a time that really seemed to be having a lot of the boost going on. Whereas like right now it's several of the sectors. Although like I said, when you're looking at it over the weekend, it can kind of show a little bit of some weird skew. So like one or two of those maybe off. That's why I say it's sort of better to just look at like which ones are actually in the positions in the portfolio. Even though on Monday it'll also shift a little bit as well, but for the most part these are staying. It's like maybe I think like two of these are maybe getting dropped off on Monday, and then I'm picking up another one or two as well. And some of them doing pretty well as well. Like I know I had commented previously about how like the idea of this strategy is not to get like a really good return over the course of 1 week or something like that, but instead to try to pick up the trend of an ETF that might be breaking out and going for several months, maybe even more than a year. And I had specifically commented on how the South Korea ETF, which I picked up in like I think it was mid-December, it might have been like the end of November, but here we are in mid-February, and it's up 46%. 46%, the South Korean ETF, which, by the way, the South Korean ETF is heavily concentrated, so that is part of the reason it's having the price action it's had. But 1.4% of our portfolio that we were in it as 1.4% after it's been up 46%. It's worth noting in that time frame, and that's just in a couple of months of holding. So obviously, it's really just trying to pick up those types of moves. We have this similar type of move over here with the small cap materials ETF up 20%. Stuff like that. There's a handful of these that are strong single digits in relatively short periods of time as well. But yeah, the point is not to, as I've said before, really make a really good return over the course of 1 week. It's to really try to identify trends and pick up on those trends and go with it. And I've had people kind of ask me a little bit behind the scenes about this overall macro strategy, because I've kind of discussed it on the channel before. It has like multiple layers to it, where there's the kind of the core part of it with these four ETFs: gold, S&P 500, small cap, and a foreign ex-US ETF. And that's kind of like the core four ETFs, which kind of make up 100% of whatever portion is allocated to this kind of strategy as a core. And those are layered together with kind of a trading strategy around each other that outperforms pretty significantly. But its base level is 30% gold, 40% S&P 500, 20% Russell 2000, and 10% VEU, which is foreign stocks ex-US ETF. But then what I've done is I've layered this sector momentum strategy on top of that, where it's paying attention to essentially all the 11 main sectors of the S&P 500, but doing the same with also the small caps, and then also a dozen or so different country ETFs to look and see which one of those ETFs are outperforming their kind of base ETF, whether it's the S&P 500, the small caps, or the foreign one at any given point, and then to maybe allocate portions over to that rather than those core four positions itself. And so that's kind of what this is right here, is that this all becomes one strategy with two parts, where there's this kind of core primary part and then this secondary part that's layered on top of that. And then technically I also have my options strategy as well, my volatility strategy, which has done very, very well as well over the last year that I've introduced it in. The backtest does extraordinarily well, but also my performance with it in the last year, I think I've done now 8 different buys and sells of options over the last year using this strategy. and I believe 6 of them were profitable. But then really the impressive part is the size of the loss relative to the size of the wins, because that's also one of the main factors. Not only is it a relatively high win ratio, but also it has a high skew relative to the losses relative to the wins. So only a sample size of 8, but it'll be more impressive when that sample size gets larger. But nonetheless, that's been a big contributor to it as well. But anyway, my point being that I've had people kind of ask me about this overall strategy is like, well, how good is it? How well is it done? And I've talked about like back tests and stuff like that, but I didn't really have a good way to estimate exactly how well the strategy as a whole is done. But I have actually done that here in the background in like last week, went through all my transaction data, and then basically layered together all of the just the instruments related to that macro strategy, and then put the final value up against the endpoint of it, and then took an internal rate of return, and it's 57.4% is the internal rate of return over my entire macro strategy, which includes basically all of the 4 core ETFs plus the sector momentum plus all of the options over a money weighted about zero point 0.4 years, but really it began in like November 2024. Like that's really when I started doing it. But like I said, on a money weighted basis, it's been less than that. It's been more like 4 months or something like that. Just because I've been putting more and more money into it. Because initially, when I first started doing the strategy, just put a little bit of money in it and I was experimenting with it. But now, I mean, well, you can see right here, it literally has about half of my portfolio in it as of right now. But that's also partially because I've been harvesting big positions, and I haven't really been finding necessarily huge replacements for those positions either. So the reason why it's become 50% is for multiple reasons. One, it's been working really well, and two, it's kind of changed my foundation in terms of like what minimum rates of returns I'm looking for the rest of my positions. Because frankly, if this part of my portfolio is going to do so well, it kind of raises the hurdle rate that I'm looking for in the rest of my positions. And so as I've harvested some of these more mature positions like the gold miners, I've been kind of somewhat throwing up my hands looking for other positions to put things in. I have added Uber to the portfolio obviously recently, but that's not the most screaming of buys in a value sense. Like a lot of the potential for high returns comes from the potential from high growth, which some of it's quite quantifiable, which is why I like the company, but other parts of the more speculative aspects of its potential returns is less quantifiable. So small position for now. We'll see what happens with that. But pretty happy with that. But yeah, either way, the point is that the macro strategy appears to be doing very, very, very well, very, very, very well. So pretty pleased with that. So let's see what else. I talked about the miners, and that's how that's been a pretty big change in the portfolio. Also, here we did have some earnings in the last week or 2 or 3, and so that's caused a little bit of some changes to the portfolio. We'll start with, I guess, the somewhat good news, which is the Generac did really, really well, had a really great reaction to its earnings. It did actually miss its earnings estimates, funnily enough. That's kind of one of the, I guess, irony parts to it. As you can see here, is that it missed its revenue estimate by almost 6% and earnings by about 9%. But nonetheless, you can see it had a nice pop on earnings, and then which has continued for the day or two after that, and is now up to a pretty solid local high over the last 3 to 4 years, ever since it kind of had its primary crashes, since we really started paying attention to it as a stock, because I mean we became interested in it, I believe, around this period right there. So yeah, very, very, very cool. And I did, because I know I had commented on it previously. I think it was back here. Oh no, I think it was back here. Back here, I did have a small trim to my Generac position here. I think it was like 10% of my portfolio, my Generac position. I had trimmed a little bit, and then I did actually buy a little bit more back in November. Not as much as I had sold, but like maybe half as much back. And then we've come back up again. So we did have a little bit of a good trade there. But then now I've already trimmed a little bit more than 10%, so even more than I had trimmed previously. I've now trimmed again, and I'm probably going to trim more here on on Tuesday, tomorrow, because it is now definitely a larger portion of my portfolio, and the value is definitely getting a little bit more stretched. It's still easily one of my favorite companies. Just I do think the overall performance is fantastic, the management's fantastic, the story behind what they're doing, their product set, the competitive dynamics, it's all fantastic. So it's one of those things where it's like I really hate to see it go from the portfolio because it's like it feels like a very secure portion of the portfolio. But part of that security comes from valuation, right? At the end of the day. But the point is like it trades at a stretched valuation, but essentially it's a stock that um, you can easily paint a story for why it deserves that valuation in many ways. But yeah, 12.5% of the portfolio nonetheless. So yeah, definitely want to trim it down a significant chunk. I think I think my targeting system wants it to probably be like half that or something. Coming back over, yeah, it says like 6.7% or something like that. And that's with giving it a lot of boosts. Like I mentioned before, a lot of these little check marks here are essentially like boosts to the target size that it's getting for one reason or another. And kind of like these are kind of in a sense different measures of my understanding of the company and therefore like confidence in my positioning around it. But it's also affected by things like the expected return, and also it's affected by things like momentum and stuff like that. And so, frankly, Generac's got like a lot of things going for it, except for the expected return part of it. So that's why it's still even allocating this much to it, is because it's basically got so much else going for it. But at the end of the day, it doesn't have the valuation going for it. So we do need to trim it down. And as I've kind of said before, it's like it does tend to be a bit zigzaggy. So it's kind of like the type of company where you feel like you might get a chance to buy it back because it just tends to be like that. So I'm probably going to be doing a significant trim to that one. As I said before, it's like I've been trying to be a lot slower about trimming my winners and kind of letting the momentum run, which is one of the reasons why I've tried to develop tools for being able to assess the momentum on a more objective basis rather than just kind of making it up as we go along. And so, like in the short run, Generac does appear to have very strong momentum according to my signals. It's also in an industrial, which the industrials are one of the subgroups that appears to be kind of running really hot as well on kind of a group basis, and such like that. So yeah, like I said, not trying to be in huge rush to it. I'm mostly just trimming it now because it's way too over allocated. But I'm going to try to be a little bit slow about it, a little bit measured about it, and probably trim more if it feels like the momentum is actually turning around on that one. But yeah, so that's sort of been the good part of the story in terms of earnings. Like I said, the actual earnings themselves were not super amazing. They had, like I said, they missed on the estimates, and then those were decreases relative to the previous fourth quarter of 2025. It was like a 2% decrease overall for the year. A lot of that driven by weak residential sales. So very strong, very weak residential sales, which there was a lot of strong kind of storm activity here in the last couple of months, which kind of lends to the perspective that maybe 6, 12, 18 months from now, there's going to be stronger residential activity because that kind of tends to be the cycle for Generac is that they have strong activity, and then over the next period of time is where they have strong residential sales as a result of that. But it's also going to be dependent on discretionary spending patterns and interest rates and construction spending and other stuff like that. So we'll see what happens with all of that. But the reason why it had such a strong pop, regardless of that kind of somewhat weakness in the actual numbers themselves, comes down to their outlook, where they initiated the guidance for 2026, saying that they're expecting to have where was it the exact wording of it, net sales growth in mid-teens percentage range as compared to the prior year, which includes a 1% favorable impact of net effect of foreign currency in completed acquisitions and divestitures. Okay, so all announced acquisitions and divestitures would be completed for that effect there, and then 1% of that was in favor of the currency impact, which gets back to discussions I've had about the dollar index and how that affects imports and exports, but that's neither here nor there. But anyway, the point is that they're seeing mid-teens minus 1% if that effect from the currency doesn't happen. But the point is mid-teens relative to minus 2% that they had this year. So a huge bounce back. And I've kind of said before, they've kind of talked about before how like the kind of baseline revenue growth for Generac is like 5 to 6% per year, but then they have strong boost years beyond that that sometimes pushes them into like double-digit growth, and that's like every year or two after a few year period where they just had their baseline level, which means that like over the long run they actually end up having like 6 to 8% revenue growth, but with the majority of the years being more like 5 to 6, 4 to 6 percentage kind of range. So the point is we've kind of fallen off of that kind of 5 to 6 range and then hitting like flat year. And now they're saying that they're expecting that double-digit year next year. So that's one of the big reasons why. Also in the transcript, which I don't have pulled up right now, they commented how their megawatt generator, the industrial uh, megawatt generators for the data centers, the backlog that they've been growing. They had, I believe, it was the first quarter they announced it 3 quarters ago. It was 150 million, and then it doubled to 300 million last quarter. In this quarter, it's now 400 million. So that's an increase of 100 million, which previously was an increase of 150 million. So you can see how like that's you can argue that the increase on a delta basis technically slowed down, which is why, but and also it's a scaling factor as well. So even if they had gone up another 150 million, that would still have been up 50% rather than doubling. And now instead it's of 100 million versus 100 million, 150 million, which is therefore 33% versus 100% of doubling. But either way, 33% increase in the backlog is still impressive. And then also it's an increase in the backlog when they have already begun and have been filling in the orders starting in this quarter. So that what that kind of also implies is that not only did they increase the backlog by 100 million, but that means that they also would have been filling some of the backlog there, so some of that there. So it sort of means that the amount that they got added onto in terms of new process orders would have still been more than 100 million. It would have been like 120 up to 150 million or something like that. But anyway, so those are kind of the two factors in terms of why the stock reacted the way it did. It's like one, the forward guidance, and two, the backlog growth, which essentially backs up the forward guidance. So that's essentially like one of the reasons why like those two things essentially go together. So that was sort of the what I'd say is like the real highlights of the earnings season so far in terms of my companies. I would say positive highlights. We have other highlights that we're about to talk to, but they're less positive, I guess I would say. So let's talk about InMode a little bit. InMode, which has been sort of the bane of my existence for a long time now. But there's been sort of a whole little drama in the background regarding what's happened with them. There was rumors going around that they were going to be sold to a company for potentially like around $17 per share, which was really, really disappointing to hear when it was trading around like $14, $15. It would have been higher, obviously, but for those of us that have been in the stock and have averages more in like the 20s, that's definitely very, very disappointing. Some of us with shares purchased much higher 20s and stuff. So my first purchases were in the 30s actually for InMode. But anyway, the point is, then there was, let me see, there was eventually a, didn't I pull up the, this one I had found, oh, there it is. Then eventually there was an actual article that came out that report that Steel Partners Holdings had made an offer explicitly to buy 51% of the company, and they had offered $18 per share. So slightly better than $17 per share, but not really that much better. Which this eventually did cause the stock to pop up with a little bit of on that sort of rumor basis. This is kind of what this candle right here was. It popped up to here kind of around $16 per share. So you can see like there's some speculation about whether or not the rumors were going to be true. But then in the days that followed, it kind of dwindled back down. And then it popped back up once the kind of formal announcement was put out about the report. And I did see some sort of confusion out there about this. I want to kind of like clarify this because like some people see the 51% of the company for $18 per share. And so I saw some people saying, oh, well, that means that the valuation is like $36 per share. That's like doubling $18 per share. That's not how they do this. When they quote these things, they always quote the dollars per share as whatever the value would be for 100% of the company. So when they say 51% for $18 per share, what they mean is that in order to buy 51% of the company, they're going to hand over like $9 per share to the company in order to get those shares. But the point is that they're setting the price for the whole company at $18 per share, right? That's sort of how it works, where it's like it's the same thing as like when you buy a share, right? Like you're buying 0.0000001% of the company, but you're buying it at whatever the share price is. For InMode, it's $14 and change per share, right? And so like that's the thing is like you're just setting the price for the whole company based off of whatever your transaction is. So they're saying that they're buying half the company, but they're only buying it at $18 a share. That's what they're setting the price for the whole company, and they're buying 51% of it at. But I will point out that, like, because like I said, when I first was hearing the rumors going around that there was somebody who wanted to buy the company, it was there wasn't anything about the specifics of the 51%. At that point, it was just people saying, "Oh, well, they're going to buy the whole company." And I find that to be a little bit of a letdown because, like I said, if you've been in it for a higher price, then that means you don't actually get out at a win. Although maybe at least you get out at a win relative to your current opportunity cost. But nonetheless, the point is that it's a less than satisfactory end to the whole story. But then when this, like I said, this report came out and it was determined it was actually 51%. That actually kind of piqued my interest a little bit more because essentially what that implies is that they want control of the company for 51%, but then there's still 49% of the company still trading, which means that I myself don't have to give up my ownership. I just essentially have to give up the control of the company, and then they're doing it for $18 per share, which means it still sets the price, and then they're essentially leaving room for the other 49% of the company to eventually rise even higher than 18%. And sort of makes think about it from like Steel Partners perspective, because like that's sort of like what they would want, right? Like if they're going to buy the company for $18 per share, it's presumably because they do believe it's worth more than that, right? Like maybe they do believe it's worth $30 plus per share or something. But the point is they want to buy it for 18 so that they can get the doubling on that value themselves. But that's one of the reasons why I thought it was kind of fun, interesting for current shareholders of InMode to get this offer of 51%, and then also smart, I think, on Steel Partners' perspective, because it essentially means that like they can get all the other shareholders on their side by them basically saying like, hey, do you want us to take control of the company and then be able to maybe actually do something with all that cash flow that's just sitting there doing nothing, collecting in the bank account, not being used for acquisitions or for buybacks or for special dividends or whatever? Because that's the point. It's like if because like I also went and looked at Steel Partners' balance sheet. It looked to me like they perfectly have the financing where they could be able to do this. Essentially, what think of it like how this would work. Steel Partners would be essentially handing, like I said, about $9 per share of actual cash and to InMode, and the InMode already has like $7 or $8 per share of cash themselves, which means now in total they would have like 16, 17, $18, however much it ends up being in total of dollars per share in cash on InMode's balance sheet when they take on the extra 51% of shares, because that would you would essentially have to dilute the shares unless people are going to offer their shares up in a tender offer. But it's being traded for that cash. That's the point. It's like the company gets the cash and then it dilutes for the share count, and then Steel now takes over, and then maybe they fire management and bring in new management. And like I said, they could literally just start the buyback machine. They essentially could just bring their cash right back out of the investment by ripping the buyback machine, and then that would cause the other 49% of the shares to start to climb and skyrocket over time. So yeah, it's like in my opinion, like this offer of 51% could have been actually a really great investment choice for Steel Partners, and then also it could have been a really great choice for current shareholders of InMode. But it is worth noting that InMode has responded to the transaction rumors and it's basically done more of the whole kind of bullshit they've done where they kind of do this silly thing where they're like, we don't really understand this letter we got from these shareholders and what they're saying. Like, we don't understand what these investors are saying. What do you mean we're not, managing the company in a way that's friendly with shareholders? Blah 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 blah. And so yeah, just kind of pretending like there's no issue with it. So we'll see what comes with that. In Steel Partners, I think had like 2% of their share count right now. So like even relative to Doma Perpetua, which is the other firm that has been sending letters to InMode and trying to pressure them, they have I think less of a shareholder ownership currently, but they themselves at least have like made offers about trying to do something substantial, more activist. So the point is the pressure's on. The pressure's on. We'll see what happens with InMode. They did report their earnings, which was less than satisfactory itself. In my opinion, they technically hit their estimates in terms of revenue and earnings, but I was kind of hoping that for the fourth quarter that it was going to be a little bit more of a turnaround corner. Technically, it was an okay quarter. It just wasn't a super great quarter. And like I said, I'm a little peeved about this whole behind the scene thing. So frankly, any quarter that doesn't come with like an announcement of more buybacks, I essentially am upset about, because it's like, all right, at the end of the day, you guys got to start doing something with this cash because not something's going on here. But it is worth noting that they are guiding for flat revenues and like a slight increase to EPS, which is a little bit of a turnaround relative to what they've been guiding for like the last like several quarters or a year or so. So maybe things are starting to turn around in terms of like the profitability side of the story. However, like I said, the revenues they're guiding for are flat, so that means that the business outlook part is not turning around necessarily. So we'll see what happens with InMode. Like I said, very, very disappointing. I had been trimming down out of InMode at various points over the last like 6 months due to like my allocation system, basically just like not liking the dynamics around it for a variety of reasons. And frankly, I've been kind of hesitant to do that at various points because I had already been allocated into it, and it's one of those things where, admittedly, there is a little bit of uh, a kind of a lost cause kind of fallacy in my head about it, where it's like I've just put so much thought behind it, where like part of me just really wants to believe that it's eventually that cash is going to get used and that it'll start to recover, and I just don't want to not be there for it, sort of. So there is a little bit of that kind of psychological effect admittedly in there, but like I said, I have been sort of trimming down a little bit. It's still 3.7% of our portfolio, and that's still well above our target size. And I did trim a little bit on the initial news about the the rumors, and then I bought back a little bit more once I heard about the 51%, and then I trimmed a little bit more on the earnings. So I'm sort of like trading a little bit down on InMode based off the news a little bit, but the goal is to somewhat get the allocation a little bit lower over time because we're less than pleased with that. But it is what it is. Like I said, it's like I'm not out of the position entirely because I still sort of think there's a lot of potential upside. It's just meaning management to wake up or new management to come along, or like I said, maybe a forced shareholder vote with the offer or something. We'll see what happens with that. But yeah, less than satisfactory about that. So anyway, on from one less than satisfactory story to another less than satisfactory story, which is PayPal. PayPal, another one that I've been less than pleased about, and I had trimmed it down over time and over previous months. But then as it had been a little bit lower, I've been looking at it a little bit more. So I had decided to buy a little bit more of it somewhat recently because previous to this earnings, I was really thought the value was starting to be attractive. And then what seemed sort of out of the blue, in my opinion, was that at the same time as they announced their earnings, they also announced that they were firing Alex Chris from being CEO, and then appointing Enrique Lores as CEO, who was on the board of directors previously, and he was the previous CEO of HP Inc. And then they also appointed one of the independent board members who was previously on the board already to now be the chair since Alex Chris was in charge of that. So yeah, a huge shakeup in the management at PayPal. And the reasons they kind of gave was essentially for them not being, what was the here? So like, while some progress has been made in the number of areas in the last 2 years, the pace of change and execution was not in line with the board's expectations. The board is confident that the appointment of Loris, a seasoned executive with more than 3 decades of technology and commercial experience, will provide leadership necessary to lead PayPal into its next chapter. So I mean, fair if you really thought that PayPal was supposed to like return to growth at a much faster pace. Like I guess that's a fine reason. Except the problem I have with that is that I went and looked at like the performance of HP Inc. Over the period of time that this guy was the CEO, as well as the period before that when he was still just working for the company. And it appears to me that Alex Chris was doing a better job at PayPal, despite the stock price really not doing well since he had taken over. Here's the decline since that announcement, by the way. So like even just like ignoring that last drop right here, like down to here, which is basically at the same levels here whereas it was in 2023, which is sort of around the same time that Alex Chris was coming in. So like the stock could not really go anywhere, but at least they had been growing in revenue and like had been growing in EPS. At least at a modest clip. Like it wasn't, like I said, it wasn't a fast clip. So I guess that's why they were replacing him. But at least it was growing. Whereas like like I said, I went and looked at HP Inc. And HP Inc. You couldn't say the same thing. It also had a stock that went nowhere, but it also had revenues and earnings that went nowhere. And this guy, like I said, this guy who is now in charge, they're like, oh yes, he has so much experience, and he did oversee the splitting off of HPQ from HP. HPE and HP Inc. from HP Enterprises. So like yeah, he did a whole bunch of like corporate management rearrangement and stuff like that. But like I said, it's hard for me to see exactly where he created shareholder value in that time frame. So yeah, I don't know. I'm super disappointed when I saw this news, and they did announce earnings at the same time. So looking at that, you can see like the earnings itself was a miss, 1.5% or so for revenue, and 4.5% for earnings. So a decent miss there. And you can see like, yeah, the stock went down on the earnings, and it is partially probably because of the miss. But I think, you see there's previous misses along its track history previously as well. So I think it's also partially about the announcement. I don't feel like I'm the only person who looked at this announcement and is like, wait, what? Because like I said, yeah, like Alex Chris wasn't knocking it out of the park by any means, but he wasn't doing a bad job, I would say. Like he'd kind of been pretty clear about what his priorities were when he first came in. He basically said that he was going to be looking at slower growth, but trying to have much more profitable growth. Like he'd said that from day one of like 2 years that he'd been there, and that's basically what he had delivered. So it's like one of those things where it's like, I get it if what they really wanted was more growth, but I don't know. He delivered on exactly what he said he was going to deliver on. So it's like, from me sitting at home perspective, I was quite happy with the CEO's progress. So it was very, very disappointing. Trimmed my position. I'm not out of it entirely, but trimmed it down pretty significantly to a much smaller position because, like, yeah, I guess like it's a lower price, so the value is definitely there now. But now I have like much larger questions about the story and what's going on. And it's already in a very competitive space, so like I understand like that's part of part of the like I said, maybe the frustrations for the board's end. But yeah, so very, 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 very strange story there with PayPal. Very, very disappointing. So yeah, those are, like I said, kind of the big changes here in the portfolio. Like I said, we talked about the miners, we talked about Generac, we talked about InMode, talked about PayPal. I did talk about that I have been buying Uber a little bit. Uber themselves, I believe, announced, which I don't think I didn't really look super closely at their earnings actually yet. I just saw kind of the announcement and was looking into the other things. So yeah, you can see here it wasn't super great earnings for them as well. But like I said, actually have not really looked super closely at the numbers for that, so I can't really overly put opine on that other than to say that yeah, I was buying it prior to that. So now it's a little bit cheaper. Now it's potentially a little bit even better of a buy when previously, like I said, like how much of a good buy you saw it as kind of depends on like what types of growth rates you were attaching to it. Because I definitely think there's significant profitability potential for Uber depending on how you look at it. So I show only 8% of upside here, but that's potentially with some conservative assumptions depending on what you think. So we'll see what's up with that. But like I said, I need to look more closely at those numbers. But yeah, so that's kind of what's been happening with earnings. Let's see what was. We're talking about the macro strategy a little bit, talk about the earnings. Let's see. We can also talk. Oh, also, before we go away from earnings, we'll say this upcoming week we are getting FG earnings, so we'll see what happens with that. Real fingers crossed, real roll the dice on this one. I have been adding to InMode, or not, wrong company I already talking about. I have been adding to FG over the last kind of like 2 months or so, little bits here and there, like really kind of like on a lot of this like last slide right here, almost daily in very, very small amounts. But there's been select days where it's like up several percentage points. I've bought a little bit less here and there, but I have been buying, have been trying to add to the position a little bit here and there. You can see it's currently at 18.3% of the portfolio. So, I think it's kind of moved up and down between 15 and 20% depending on what has been going on with other stuff, and also where the stock itself has been going. But yeah, so it's been interesting to see. As you can see right here, we'll get earnings here on Thursday. So here's hoping for that. I can't remember what the date was, but it was after the final split of the stock, which was kind of like after New Year's. So I think it was somewhere around here that we had Chris Blunt, the CEO, did an open market purchase, relatively small one. He only bought like 5K shares or something like that, but he did do an open market purchase right back here. And like I said, it's kind of really since then, so that I've been mostly been buying. Hopefully that's a sign that he's feeling pretty good about the forward earnings of the company, but at the same time, he seems like he's just kind of largely accumulating. We did get the preliminary fourth quarter estimates for 2025 here for the annuity sales, which really weren't amazing. They're not super weak, but they're definitely not super amazing. And they're stronger in the variable category, where FG is more in the fixed category. for their annuity sales. So it's definitely not the strongest fourth quarter numbers that I've ever seen here. So we'll see what happens with that. But admittedly, there is a little bit of some kind of natural tailwind in terms of the revenue and earnings growth for FG, just because of how poor the first and second quarter of last year was. So like as we move into the next two quarters, essentially it becomes much easier quarters for them to beat just on a natural basis because of the kind of the basing effect. But nonetheless, this here, the fourth quarter, the one that we're talking about right here, it could, maybe it won't be the strongest quarter. We'll see what happens with that. But this is also just the overall category. It could be that FG does pretty strongly on kind of a relative basis. And this also only focuses on the retail annuities. This doesn't say anything about the institutional sales, like, for example, what's happening with the pension risk transfers or the asset-backed funding agreements, which FG has been trying to do more and more of. So it's possible that those parts of the business, which we don't really have these kinds of ins and outs prior to the earnings coming out, beforehand. So we'll see what happens with that. I have been sort of trying to compare them to some of their competitors in terms of what's happening with the stock, as well as BXSL, which, like I said, the Blackstone Secured Lending Fund is a kind of somewhat of a proxy for similar private credit assets that FG owns, and they're also managed specifically like by Blackstone, which manages over 80% of FG's portfolio. So this is kind of like a similar fund with a similar assets, and you can kind of see how the go back to actually FG as a primary here, and compare with these two right here. You can see how correlated they've been over the last like handful of months. FG with a little bit more volatility to it because it has a little bit more of an equity pull to it. That's one of the things I've kind of been looking at to kind of remind myself that while FG has some annuity industry related struggles, and then obviously has struggles related to itself in like because of the share issuance it did last year and sort of like a loss of confidence surrounding that, and factors like that. But at the same time, I try to remind myself that it's also, I think, related to this private credit asset scare that has been kind of plaguing the market for the last handful of months, really ever since kind of like August, September last year. So it's like you see like they correlate only so much prior to that, but then once you really narrow in on that period there since August, September, you see how much more correlated suddenly they become. So what that points out to me is that like as long as I'm correct in my thesis that well, I mean, private credit, there could be some serious boogeymen out there, but I have reason to believe that FG is going to be largely, if not completely, impervious to all these concerns. So all of that is completely just noise. And if that's the case, well, then like this whole correlation doesn't make any sense. The FG should just be able to ignore this altogether. In fact, frankly, that also means that even BXSL should be doing a lot better than it really is right now as well. So like this is one of those factors, and then there's also the yield curve, which I was talking about throughout last year. About that, I was saying that was like a big catalyst to push for FG's profitability on a going forward basis. And I was talking about that a lot. Frankly, like I started talking about that a lot at the start of last year, which was kind of an inconvenient time because that was when the yield curve started to retrace a little bit for a handful of months until Liberation Day, and then it's been starting to recover since then. But then you can see it's been a very, very slow recovery. And then here in November, December, suddenly got a big lift up in the yield curve, and then that's retraced a little bit in the last week or two. But nonetheless, over the last year, especially the 2 years, it has been moving upward. It's just been, fits and starts a little bit. And this is also the 10-year, 3-month yield curve, which is like the most complete version of looking at the yield curve, I would say. But probably the most common way of looking at it is the 10 minus the 2-year. So if you look at that, the 10-year minus the 2-year, oh, it's not that bad. It's a similar story, but a little slightly different. Whereas like where I was talking about it at the start of last year, it did go up a little bit further, and then it was even flatter for the mid portion of last year. And then at the same time as last year, November, December, it's been sort of improving a little bit on a kind of go forward basis. But like looking at both of them together, which is sort of like the two most kind of complete ways, like I said, to look at the yield curve, they both are trending upward, and both are at relatively low levels comparative to history. And that's kind of the point, is that like if we're going to head back into sort of like a semi-normal economy where things are growing and inflating and things like that, well then generally speaking you have this kind of activity up here. So my expectations is that this will at least get up to like 75 basis points, if not getting up over 100%, 1% kind of level, something like that. It just might take time, but nonetheless, like I said, this is good for FG's profitability on a go-forward basis. And then at the same time, it's also at the same time is that uh, the uh, the book value of FG as well. That's one of the other kind of major catalysts I've kind of tried to point out to people. That it's basically just a time factor. Is that if you believe FG's book is good, which is the same thesis I've been saying about the private credit assets, like if you believe their assets are good, and therefore you believe that the growth of their equity is going to be good, then that means this right here, this negative number, this negative comprehensive income and other, which subtracts from their equity and their book value here, and as you can see, it appeared in 2022, which is when interest rates are jacked up. That's essentially the value of their bonds having declined due to interest rates going up. But they don't care about that because they don't trade bonds. They hold bonds until maturity because they have long-term liabilities, which allows them to do so. So essentially, as you can see, big number has been getting smaller, which has been getting smaller, which has been getting smaller. And so my point is that itself is a process that's going to continue and continue. And as it does that, it's adding to the value here, the actual total common equity. And so basically a catalyst to say that there's like a natural significant growth to the book value baked into the cake just because of that. It has nothing to do with them expanding their business. So they are, and so it's just like if they're growing their business on top of that, that's just another compounding factor. And then combine that with, like I said, the private credit scare and confidence factors, which layers back into like this, which is their price to book, which is currently 0.79, right? Relative to the 1.33, which is the average since they've been a trading stock. But then you could say 1.0 is the average for the last year, or 0.91 is the average of the last 6 months, 0.97 being the average of the last 3 months. So here they are at 0.79 on pretty much all those bases. Their book value is cheap, and as I've said, their book value is likely to grow significantly. So all the kind of mathematical reasons I can point to as to why I haven't really lost super faith in FG. I start talking a lot about how I've my confidence has been shaken pretty significantly when it comes to InMode and PayPal, but FG, while it has also been a bit of a dog stock wise, as far as I'm concerned, I can justify what's going on with FG so much more, both because of the numbers, the macro environment, the management, and also the things management says and what they do. By buying more shares themselves, for example, helps give confidence in that front. But yeah, so that's where we stand with FG and annuities. Like I said, we'll see what happens this week on that front. All right, so let's see. How long have we been going for? 52 minutes. Okay. So let's see. So did want to talk about this a little bit today, at least. It is in the thumbnail, but a couple weeks late to the discussion, but we did finally get our announcement for the new head of the Federal Reserve. I know I talked about it a handful of times before, the kind of like top contenders and how I saw them, but Kevin Warsh is now the new pick to be the head of the Federal Reserve. He does have to be confirmed by the Congress, so we'll see what happens with that. Maybe that'll be easy. Maybe there'll be a lot of drama there. I really don't have a whole lot of input into that. But what I will say is that Kevin Warsh, as far as there was kind of like 4 top contenders, and I would say like he was probably my second favorite pick out of the 4. Admittedly, that my favorite pick was a lot better in my opinion than the next 3, and then so it was like the top my top pick, which was Waller, who was not picked, and then there was Kevin Warsh and Rick Reeder, in my opinion, kind of in the middle that I thought were interesting for different reasons. And then also there was Kevin Hassett, who I liked the least out of the 4. So he picked my second favorite pick, who I like for a variety of reasons, but there's also lots of reasons where I think I would like him. I don't like him necessarily too much. Kind of it's a mixed bag in some regards with him, but overall, I think he was an okay pick. What I will say, kind of thinking about him, is that he kind of has this reputation as being a hawk, which is sort of like it's almost like the parties at the Fed. Like they're not Democrats and Republicans. They're hawks and they're doves, and the hawkishness and the dovishness doesn't necessarily depend on the other forms of politicalness. It kind of often depends on your own academic background in terms of what you believe economically, but then it's then affected by various layers of politics on top of that. So like Kevin Warsh is known as being a hawk, which means that he's very concerned about inflation and tends to be like more leaning towards wanting to raise interest rates in order to combat inflation. That's sort of his historical reputation. But I will say that it's a little bit more complicated than that because I've seen like charts where it shows different comments Kevin Warsh has made with interest rates at different points and at different points in time, and also pointing out like who is in office at those different points in time. So because it's pretty clear that he does have like a historical reputation for being hawkishness, but a lot of those points where he's pointing out that he wants to be super hawkishness, you could argue was him reacting politically to certain things going on that he himself was concerned about. And so while he was saying that he wanted to raise interest rates or keep interest rates high because he was concerned about the concerns for inflation at that point in time, those concerns were based off of actions that were happening politically and not necessarily the data as it was coming in. It's not like inflation was rising and he was concerned about inflation. It's more like he was concerned about something about inflation that could come in the future due to the actions of politicians now. Which I mean, I have opinions about all those sorts of things too, and I wouldn't even necessarily disagree with him on those things. But you could argue about whether or not that's the appropriate way to handle the Fed. It's worth knowing, and people have these opinions about these things because Kevin Warsh was previously a governor at the Fed, which is one of the strong points in his favor as to why he was a good contender for the new Fed chair, is that he literally had experience at the building. He was one of two of the four who had previous experience in the building. My number one favorite, Waller, who didn't get the pick, was also and is currently at the Fed. So like you can see like there was some favoritism towards people who've already been in the job a little bit, but because one, it'll be easier for them to get the nod from Congress, and then two, it means it'll be easier for them to wrangle the votes at the FOMC going forward. Because people have to remember this too. People tend to pretend like the Fed chair can just like wave a magic wand, lower interest rates. It's like no, it's a vote of 12 people that lowers the interest rates. So it's the Fed chair has the most influence and the most say, but he still has to go around and kind of try to wrangle everybody's votes together. And if he can't, well, then you end up with some dissenting votes, and maybe the vote doesn't even go his way. Like that doesn't really happen super much historically. But the point is well, it's not a one man show. Is my point. So the point is like Kevin Warsh is good because he has that back experience. But he's also good because he's known as being a little bit of an inflation hawk, being the type of person that tends to be concerned about inflation. But then the people will look at that and say, okay, well then why would Trump pick him? If Trump really, really desperately wants interest rates lower, wouldn't you think that he would want to pick somebody who has kind of this history of being concerned about inflation? And it's like, well, like I said, his concern about inflation is sometimes based off of what he expects from the future, not based off of the current data. And that's sometimes based off of a political perspective, which means that if he believes that the things that the politicians are doing now isn't going to cause inflation, well, then maybe he's going to be a little bit less hawkish towards that administration, i.e., potentially the Trump administration. And also, it's worth noting in the last 6 to 12 months or so, Kevin Warsh has made a variety of comments about how he would like to lower interest rates and why he would like to lower interest rates. He's made cogent arguments as to why he thinks we could lower interest rates further. And many people made the argument essentially that he was essentially interviewing for the job. He was trying to convince the president, by making these appearances and saying publicly about here's why we can lower interest rates, and things like that. That gets back to why I have the balance sheet up here in front of us, by the way, is that one of the major things that he's trying to point out to people is that when it comes to monetary policy is done with two tools. There's the balance sheet and there's interest rates. So they raise and lower interest rates. They lower interest rates to stimulate the economy, and they raise interest rates in order to try to stall out the economy. But they also have the balance sheet, which is all the assets that they purchase through monetary easing of the economy in some form or another. And this is composed of a bunch of stuff that they bought. And whenever they buy those assets, that itself is also easing the economy. And then when they sell assets, that is them restricting the economy. So here, at the same time when they were raising interest rates, they were also selling off a bunch of assets in the economy, specifically treasury bonds and mostly mortgage-backed securities from when they had bought a whole bunch of mortgage-backed securities previously. And you can see that's slowed down dramatically. They've come mostly to a standstill in that front, whereas interest rates have also been coming down to the raising of the interest rates had been brought to a standstill, and then also they'd started to lower the interest rates over this time frame as well. So my point being is that what Kevin Warsh, as well as other people, but Kevin Warsh himself has definitely very specifically made this argument, is that we could potentially lower the Fed funds rate further, and not necessarily stimulate inflation without everything else equal, ignoring all the other factors, the real causes of inflation, which comes down to money printing from unstable deficits and stuff like that. But he thinks that we could actually lower the Fed funds rate even further if what we did was also sell more of the bonds or more of the assets off of the balance sheet. So, because as you can see here, usually you have interest rates going down at the same time as the balance sheet is going up. In fact, I can inverse them so you sort of see that they're. So normally they go up together, and then they're sort of flat, and then they kind of go down together, and then they go up together, and then they go down together. See, like that's basically what the pointing out is, that the normal policy is to use both of the tools sort of in the same direction at the same time. It's like if the green line's going up, that's interest rates going down. Interest rates going down is at the same time as the balance sheet goes up. And so you can see like they tend to move together. And so what he's pointing out here is that we could have actually them not go together. We could have the interest rates go down, which would be the green line continuing to move upward. But at the same time, we could then have the balance sheet, instead of it starting to purchase assets, which would be easing, you could have them selling assets at the same time. So you would be getting an easing from the lowering of the interest rates, while you would be getting a tightening from the selling of the assets on the balance sheet. And that's basically the argument that has been made. And I think there's some strong arguments that could work out. I'm not sure how well the economy would like it. That's kind of the one big factor about this, is that you, like for example, as we discussed here on the channel a few streams ago, I was talking about my concerns about short-term liquidity, and a lot of that short-term liquidity has to do with balance sheet dynamics. So it's one of those things where it's like, we'll see on that front, because it's a little bit tricky, because I don't believe they could sell short-term assets, because short-term assets are that short-term liquidity that they would need to still be able to bolster. And one they would be able to do is sell the long-term assets, which admittedly is the assets that they've said they want to sell, because by selling long-term assets, they can get the balance sheet back to its kind of more traditional ways of being managed, which is to say not by having a whole bunch of mortgages on the balance sheet and stuff like that. Let me try to get the assets, mortgages. And we'll get rid of the interest rate. So here, this is the total balance sheet as I'm talking about, and then this orange line right up here is the amount that is composed of mortgages. So you can see like it's like a third of the balance sheet is just mortgages, and you see that they didn't used to have any mortgages prior to 2008, and they bought a whole bunch of mortgages, and then they kind of stayed somewhat steady with them. They went up with the balance sheet as a percentage, but they kind of stayed steady as a percentage, and then they bought even more of them in 2020, although they bought even more bonds, as you can see there. But yeah, so this is what we're talking about, is that they're basically arguing that they want to try to normalize this. They're saying that they want to sell the assets down. In particular, they want to sell the mortgage assets down at the same time as they lower the rates. And like I said, like by doing so, that means that they would be selling the mortgages, which are not short-term assets. So that means it wouldn't be affecting the short-term liquidity dynamics. But if you're selling mortgages, that means that you're going to be putting a lot of pressure on the housing market. And that could be tricky for the economy to withstand that. And that's at the same time as you'd be lowering the Fed funds rate. But the point is like mortgages are off of the 10-year, which is the long-term rates. And lowering the Fed funds rate doesn't necessarily lower the 10-year. One kind of detail I have heard people talk about with this is that they could actually try to do essentially an asset swap, where essentially they take all these mortgages right here, and they sell them off of the balance sheet of the Fed, and then have the Treasury buy them, which means that the Treasury would then be buying them by swapping them for Treasury bills. So essentially, they would be speeding up the process of getting the balance sheet back to a shorter term duration, which would essentially get one goal done. And then the Treasury would then have all of these mortgage-backed securities, which then they would transfer over to Fannie and Freddie Mae, who would then issue a bunch of mortgage bonds that insurance companies would then be able to take over. So I've heard some ideas about how they could do this, but it's one of those things where it's like uh, I don't know. It's like I've heard ideas about these things online, but it's like who, whether or not these are ideas that people like Kevin Warsh are actually thinking about, or whether or not the Trump administration would actually play ball with Scott Bassett and all that. Sometimes it sounds like really really smart ideas from policy wonks who go around the YouTube podcast kind of circuit. But how much of that is stuff that's really going to happen, I don't know. But the point is that Kevin Warsh is one of the people who has talked about doing these types of things previously, and now he's the person that was picked as the Fed chair. And then one of the other factors I did mention is that why it seems like maybe he was the person who was picked is that he also does have like some like kind of personal ties with the Lauder family of Estee Lauder fame, who all themselves have ties with the Trump family. So there could be there. It appears that there's a little bit of a backdoor kind of connection between some of these actors that could help explain as to why they picked these people as well. And then Kevin Warsh was also somebody who worked for Stanley Druckenmiller's office, I believe, who worked with George Soros, who Scott Bessent also worked with. So it's one of those things where there's like all the people involved in doing these actions all appear to have ran in the same circles with each other, and it sort of appears to maybe be a little bit of a kind of like rubbing elbows and nodding shoulders at each other, kind of wink wink, here's what's happening kind of scenario. So we'll see if there's ever any big announcements about these things or not. It could be that, like I said, that was all just smoke and mirrors for Kevin Warsh to get selected as Fed chair. Like maybe he was, like I said, maybe he's super political, and so maybe he's been hawkish in the past because Democrats were in charge, and then now that he's going to be Fed chair and with a Republican in charge, maybe he'll just be super dovish and lower interest rates. Maybe that's possible. It's also possible that he was saying, "Oh, here's how we can lower interest rates" to Trump last year because he really wanted to be Fed chair, but he actually really is a hawk at heart. And then maybe he gets in and doesn't lower interest rates at all. That's possible too. And then, like I said, maybe it's possible that there's some sort of middle ground in here where there is ideas about how they can lower interest rates while still maintaining the restrictiveness by switching out the balance sheet, which could get the housing market moving. Like I said, there's all sorts of smart ideas about what they actually could really do with the economy, but I don't know how much of that is just smart people on the internet who don't actually have any influence whatsoever. Which I guess maybe we'll count me in the bucket of those people if I'm gonna go out on a limb and call myself smart, but I certainly don't have any influence. So it's like one of those things where it's like just because you can come up with ideas about how they can fix the economy doesn't mean that the people in charge actually ever do anything related to that. So anyway, that's the Fed balance sheet and Kevin Warsh. Like I said, we'll see what happens with the confirmation hearings or not. So it'll be really interesting to see if he does get confirmed. I have a feeling he will get confirmed, but nonetheless, politics is crazy right now. So people like to hold up the other side for any and all reasons, fairly or otherwise. So we'll see what happens with that. Let's see. I think that's most of everything I wanted to talk about here. I had a couple of things I sort of want to talk about, but we can talk about those on another show. Yeah, I think that's. Oh no, one other thing I did want to talk about, my new tools that I put together over the last week or so. I put together some pretty cool pricing and screening tools, which are going to be very useful for a variety of different reasons. Yeah. Over here at Tinker Terminal, it's used primarily off of the screener they have here, which I mean, obviously they have a really useful screener here at Tinker Tab. But one thing that I've kind of noticed you can do with them is for most of these same things, rather than screening for a specific category or something, you can click just a display only factor, and you can do that for a variety of different factors. And then when you do that, it essentially will show you the results for all those things without actually screening anything out, and it essentially allows you to look at thousands and thousands of various fundamental metrics for thousands of companies across dozens of countries, if you so desire, and whatnot like that. So my point being is that like you can screen in here, but like one thing I like to do instead is instead of screening, instead use a relatively basic kind of screen to clean out some of the kind of like poorly data constructed companies, but for the most part just collect a huge amount. Like right here, this is a list of 9,000 companies, and then just download all of that to a spreadsheet, and then do screening myself here, where I can manipulate the data myself in a variety of different ways. So that's one thing I've been doing over the last week on Ticker. It's basically come through, and I've created a US, Canada, UK version of the screen, but then also an international version of the screen. But you can look at the US English speaking world screen here. I have kind of like all the main data, which I paste in here, clean up a lot of the data, and make sure everything is all in like form. And then I filter out anything where they don't all have the same form of data. And specifically, I'm mostly looking at a lot of like the forward metrics. So like here whether or not they have forward estimates for revenues, net incomes, and EPS for the next year, 2 years, 3 years, and even up to 4 years. Because what I want to do is like these are usually based off the fiscal years, and like if you're in the middle of the year, you actually sort of want like a weighted average of the EPSs between like years 3 and 4 to sort of get an idea of what the 3-year forward EPS is. But the point being is that I'm trying to build up a screen where I can get a bunch of cleaned up pricing metrics for tons and tons of companies to get an idea of like what typical pricing metrics are for tons of different companies. But rather than doing it through like Ticker's screening, which I've done in the past and is okay, doing it through my own data cleaning processes. So I've done like all those many steps to like the process here, but I've also kind of built up a process where I can repeat this. I can do this like maybe once a quarter or something like that. But anyway, end up with this final list over here, which has what is it in total? It has 1,186 companies from the U.S., Canada, and the U.K. That, like I said, all have analyst estimates. That's kind of like a requirement of it, is that it has to have analyst estimates for the first several years, to be honest, and also has like kind data, which basically means that it automatically would be trimming out companies that don't have analyst coverage, but also would be trimming out companies that don't have positive earnings expected in those years, because you need to be able to do positive earnings in order to look at actual multiples and stuff like that. Anyway, so a whole bunch of companies in there. Like I said, 1,100, almost 1,200 companies, but 1,200 relative to like 10,000 that it could have been or something like that in the U.S. So there is a huge amount of companies that have already been screened out just by filtering for those companies here. But then looking over, I do have distributions right here that you can look at. My head's a little bit in the way here. But here's like an actual distribution of it bucketed pretty neatly. Obviously, there's a huge outlier bucket with for companies that have really high PEs, but you can see and it doesn't pay attention to market cap, so this is all market caps. It's just like I said, whether or not it has that analyst coverage or not, which means it is going to skew towards larger market caps, like $10 million market cap companies tend to have analyst coverage and whatnot like that. But still, and here you can see the modal outcome being between 14 and 18 for a forward PE. These are forward PEs that we're looking at for the record. But also keep in mind that I'm using the analyst estimate of GAAP earnings, not an adjusted or normalized earnings. And when most people talk about forward EPS, they're talking about adjusted or normalized EPS, and that and therefore when they quote forward PE ratios, they're also usually doing it off of those adjusted normalized numbers. So that inherently makes the forward PEs that you normally hear smaller. So like over here, for example, I show what the median forward PE of all these companies is 22.3, and that might seem a little bit high compared to what you might expect the median forward PE of analysts covered positive earning US, Canadian, and UK companies to be. And that's because, like I said, the earnings might be a little bit smaller, so the PE might be a little bit higher. So like really, that I don't know what would be a correct way to adjust for that, but it might be like a 20 versus a 22 or something like that, 19 versus 22. Oh, Jeff, I see you were commenting there. I wasn't looking over there for a little bit. Happy coming live. Still pulling from Ticker. I was using old format you used, but now all the metrics are paid. Yeah, Ticker has really shifted things around a lot. That's the thing, is like I wasn't using Ticker too much there for a little bit of a period. I had stepped away from their subscription for a handful of months there in like the second half of 2025, and I was experimenting with a few other services, and I was kind of like looking around, shopping around, basically to see like if there was other websites that I thought might offer better services. And like specifically one I was really interested in was stockanalysis.com, which I do like looking at a lot of things on stockanalysis.com. I think they're very useful for a lot of things. Like I have like a kind of a general watch list for earnings that I like to look at on there. That's like one thing I like for this website. But I was looking at one of their paid things. I was trying to consider if they would be a good replacement for Ticker. And because they also seemed like they were slightly cheaper and seemed like they had maybe a little bit better of offerings as far as like analyst stuff goes for U.S. companies, but they didn't seem to have as good of stuff for foreign companies, both in terms of analysts, but also in terms of screening. And so it was one of those things where I was like, I guess I'll stick with Ticker. But yeah, I did re-sign up with Ticker, which yeah, they've limited more of their free stuff. I noticed. But they also technically expanded a little bit more of the features that they give to that first bot tier as well. So they have like they gave it a couple more years of stuff. But yeah, I am back on Ticker. Back on Ticker. Like I said, I was sort of looking for other options. I was looking to see if there was a better option out there, but I decided in the end that it didn't really seem like there was too much better out there for the price. There's services out there that have better features in certain categories, but they weren't necessarily better for the total package and the total package of everything I want to do. That's kind of the other aspect of it. So, um, oh, that outcome you said there. Really love the philosophy of not screening out for the cheapest, but by metrics, but rather comparing an entire sector or industry to like competitors to figure out which one is the right one. Yeah, no, and I definitely still believe that is largely the approach to take things with. So kind of get back to what I was talking about with here with these tools that I've been building here, that kind of somewhat fits into what I was talking about with that, where yeah, instead of just looking for cheap stocks, I think it can actually be a very dangerous rabbit hole to go down, just screening for what's cheap because it doesn't really give it any context to why it's cheap at all. So you really do have to be able to isolate for a lot of different things to be able to try to determine why something is or is not cheap or expensive for that matter. Like there's kind of the famous quote, which is somewhat apocryphal, and I can't remember whoever said it, but it's like you don't need an analyst to tell you why a 10 PE stock is cheap. You need an analyst to tell you why a 40 PE stock is cheap, right? Like that's the real trick to analysis. And there's obviously complications there because you might need an analyst to tell you why a 10 PE stock is actually expensive. Like that might be a useful skill as somebody to tell you why it's actually expensive, even though it says 10 PE right there. But yeah, you want to make sure, when you're looking at PEs, adjust for the industry it's in, adjust for the sub industry, adjust for close competitors, adjust for margins, adjust for expected growth rates. And so, yeah, getting to that here, because I was just pointing out the distribution of the forward PEs, but here there's also this nice little scatter plot here, which shows you I am essentially attempting to adjust for something, which specifically I have forward PEs, these, like I said, forward gap PEs on a scale regressed against forward EPS growth rates. But specifically, what I'm using here is the EPS growth rate, not the first year, so not from the trailing year to 1 year from now EPS, but from the 1 year now EPS to the 3 year EP now from EPS. So if you get what I'm saying, it's like not the first year, but year 2 and year 3. What are the EPS growth rates for that? And the reason why I do that is because like it's actually very easy to show an obvious correlation between year 1 EPS growth and the forward PE ratio, because the forward PE ratio already has year 1 EPS growth in the number. Like the PE, it has the forward earnings, and the forward earnings is last year's earnings times the forward growth rate, right? So the forward growth rate is literally already in the denominator. So of course it's going to correlate. It's like there's like a popular show of forward PEs regress against forward growth rates. But the point is like, actually, you have to go beyond the first year is basically what my point is. You have to look at year 2, year 3, even more years ideally would be better. But I'm specifically looking at year 2 to year 3 EPS growth rates. And here you can see how well the regression works. It's a big old scatter plot of 1,000 companies here. This one up here at the top shows the whole scatter plot. And then I have the PEs here on a log scales, so I can go all the way up to PE 500 and EPS 150. But here it's zoomed in specifically on like 60 PE below and 60 growth rate and below. So really it's like this little box right here zoomed in on. And you can see like, there's a nice strong positive correlation with an R squared of 24%, which with an R squared of 24% usually means that like the correlation is probably like 40 to 50%, pretty strong. Jeff, I joined super late and we'll have to go back. Did you happen to talk about your Uber movement yet? I only really briefly commented on Uber to say that it was part of the portfolio. And, it's definitely one of the ones that I'm adding to. It's a very small position, and hoping to add to more to it going forward. And I did comment on the fact that its earnings was a little bit weak. I had been buying prior to earnings, so now it means I get to buy into that a little bit. But it's a small position, and I'm excited to maybe add to it, but I definitely want to do a lot more research into the industry in terms of like what total size of the industry can go to, because I did build up a revenue growth model for the company, which is one of the reasons why I'm willing to start to allocate into it, which is sort of like a bottom up assessment of what its revenues could be. But I'd like to also do sort of like a top down estimate of what its revenues could be by looking at like the total industry, and then try to think about like what slice of the industry that Uber can get, and then look at their competitors a bit as well. So like that's kind of like the next steps I could do to turn maybe grow this into a larger position. And then because like my assumptions around the valuation I have, like I think I'm being reasonably optimistic on what I'm doing with the net margins and in terms of what I'm doing with the revenues. But I do have some serious questions about what I could do with the cash flows and then the terminal multiple as well. There's big questions about what to do with that. So like here, like on here, it only shows like 8% upside, 12% to 13% expected IRR returns. So like not too shabby, but certainly nothing to write home about at all. But like I said, like you could easily boost the assumptions I have in there. So that's why it's like I'm not doing a lot with that position yet because I haven't done a ton of research on it. But I just kind of took a little tiptoe position in for now. We'll see what happens with that. And then I also have been mentioned that I know earnings had come out, but I actually have not really looked closely at these earnings yet. It's I know I'm like a week or two behind, but I was focusing on some other stuff there. But yeah, getting back to the pricing screen though. So what I did here, obviously these little regression screens are cool, but what's useful about this is that it aggregates the whole market and makes me able to look at a variety of metrics on kind of a whole basis. So like I can get a look at like what is the forward revenue growth rate for all 1,200 of these U.S., Canadian, and U.K. companies, which by the way, for the forward 1 year happens to be 3.1%. What again within that subsection is a subsection of companies that have positive reported earnings and positive expected earnings next year, and actually do have analyst coverage for the next 3 to 4 years. In the next 12 months, the margin, what is the net margin expected for these 1,200 companies? About 11%. What is the next 12 months EPS growth rate expected? 6.6%, right? So it's like it's kind of cool to be able to kind of aggregate. Or my bad, I was saying the aggregate. Those are the median numbers. A median revenue growth rate of 3.1%, a median EPS growth rate of 6.6%. If I did the aggregate, it would actually be higher. It would be 5.4% and 16.1% for the EPS, which 16.1% for the EPS growth rate just goes to show also partially like why the market as a whole can have the market pricing it has, right? Like if the market as a whole is priced at like 24 times forward earnings, why would it be that way? Well, maybe because the 2 years expected afterwards as a whole is expected to grow 15% per year, right? So it's like, for example, if they take a 24.3 multiple and then I adjust it down by 15%, oh, whoops, hold on there, my bad. Wrong spot to click. Adjust it down by 15% and then adjust it down by 15% another time, which is the second year, then that gets you to 18.3% for P. So it basically means that like if you take year 2 and year 3 growth rate into account, then the forward PE at year 1 doesn't necessarily seem too crazily out of character. That's kind of like the point I guess I'm trying to make here as a whole. And that is the strongest, most correlative factor. I have looked at a variety of other factors. I looked at like is year 1 margin, year 1 growth rate, the year 2 to 3 year growth rate, the liabilities of as percentage of assets. I looked at market cap. I looked at a variety of other metrics as well. But like the most correlative factor is the growth rate in EPS in year 2 and year 3. If you want to look at the forward PE, which is reliant on the year 1. And then, so like I said, this is all 1,200 of the companies, but getting to kind of the comment you were talking about, you mentioned earlier, Jeff, about wanting to be able to analyze and screen for things on a more narrow basis. I then was like, okay, well, what if I do this and then narrow it down? And so what I've done here is I've also filtered out for materials, energy, financials, health, real estate, utilities, all 11 of the main sectors. And so I said, okay, well, what happens if you then try to regress the same data against just a specific sector? And it's true, you do actually get, depending on the sector, some of them are stronger, more even more correlative relations, and then other ones that are weaker. It kind of depends on which ones you're looking at. But nonetheless, it can get you a little bit more accurate information there too. And then also within that, then you can also look at those same metrics I was talking about. If you want to know what is the 1 year forward expected revenue growth rate for the materials sector as a whole, then I can tell you that that's going to be 5.6%, and that the median company is 6%, which kind of goes to show that there's actually going to be a significant amount of losers probably in the sector, but then a decent amount of companies that are going to be carrying the sector to a significant degree too. Maybe if you're looking at consumer staples companies, maybe you want to know what is the 1 year forward expected net margin of all consumer staples companies. So like you're looking at a consumer staple company, you're like, well, is my margin weak or strong? Well, 6.1% is what the net margin of the consumer staples company sector is going to be over the next year. Again, specifically filtered to companies that have good coverage. So you even that would argue that that means that that's probably going to be a somewhat positive sample within the overall staple sector, because it's not going to include, like I said, a bunch of smaller companies that don't have coverage that might have weaker financials as a result. So yeah, it's sort of like a pricing tool, because it allows me to look at like what is the typical pricing look like across all these different sectors and across the market as a whole. But it's also a fundamental analysis tool, because it means I can use this fundamental data on the growth rates and the margins over all the expected data to get an idea of like what's normal for all my valuations going forward. And also, though, then it's another thing I can do even further is then I can also use this as a screening tool as well. So like if I did want to go say look at U.S., Canadian, UK industrials, so here I go over to the industrial page, and then I come over to this, and it says that, as we were just saying, that the next 12 months revenue 1 year growth rate for the industrial sector as a whole is 4.7%. Well, what I could do is I could set up a filter here to then filter out all revenue growth rates that are less than 4.7%. And I can do that for really as many of these columns as I wanted. I don't want to do that right now, but the point is like I could filter this list of 208 industrial companies down to whatever, the top 10 or 20 companies I want based off of that. And then I'm not just doing it off of like a random growth rate. It's not just like me saying, I want 5% or higher. I want 10% or higher. I want 5% or 10% margins or higher. It's instead based off of, well, like what is typical amongst the analyst assumptions out there. So yeah, this is the tool I've been working on over the last handful of days. Here, like I said, I'm showing you the US, Canada, UK version of it, but technically I made a second version of it that I call the rest of the investable world, that includes like another dozen or so countries, China, Germany, France, Brazil, Australia, a bunch. Like I said, it's like a dozen different, Japan, like a dozen other countries or so. So I sort of have like an international data set, as well as a not exactly like not a US data set, because it's US, Canada, UK. I chose those three countries specifically because I sort of treat those three countries as though they're roughly the same in terms of like my own investable experience. That's my own personal choice, but like in terms of their legal structure, about how they treat shareholders and property rights and things like that, I roughly treat the three of them the same, and feel like my shareholder rights are going to be protected in the UK and in Canada roughly the same as they are in the US. And while I'm willing to invest in other areas, the point is that that's kind of like the line where I start to consider foreign investing as much more risky, is when it's outside of those other two countries. But that, like I said, that's just kind of a personal choice. You could have still had Canada and UK with the other countries if I wanted to do pricing metrics, and obviously you could have done like a US and then it had a developed and also had like an emerging markets group if you wanted. I didn't really do that. I don't really like on one hand there's like some logic to the splitting of developed markets versus emerging markets. Like there is some logic to that, but it's also a very arbitrary line in the sand for a variety of reasons. So I don't really think about it that way. I sort of think about it as like, what is your own personal assessment of investable risk? And that's kind of like how I chose to split it up. But anyway, so those are like I said, the pricing tools I've been working on the last few days. I'm going to be filling with those more over the next few days because, like I said, they're useful tool for industry research. It's a useful tool for screening for specific companies. And it's also just a useful tool, like I said, for kind of like having an idea of like what margins and growth rates to use in the valuations I'm doing. So like I said, I worked on this over the last week or so, but then literally over the last 2 days, I literally updated about a quarter of the companies in my watch list here, and I'm planning to do many more. Like these orange highlighted ones here on the left hand side are the ones I'm planning to update here. And then hopefully I'll do the majority of those today because I'm not really doing too much else today. And then really there's a handful of the gray ones that are left over that still need to be updated as well because I didn't bother updating any of the ones whose earnings haven't passed yet. So they're all the ones whose earnings are going to happen here the next week to 4. There's going to be a significant amount here. So like here, if I sort by this column here, which is the date I last did evaluation on them on, you can see that in the last month, I have updated all of these valuations, like 24 out of, or well, 24 minus 6, so 18 out of like 45 or so. So pretty good there. And then if I sort by the earnings dates, that gives you an idea of how many more the earnings dates still are there to come, which is this many. So that's 17 out of the 45. And then there's like a handful in there that I'm really just not even going to bother updating because, well, I don't really need to update every single one of them. I just update the ones that I feel like I need to. Let's see, Jeff had said there, oh, that his last comment there about Uber. Sorry to distract, no problem. Both of my models for Uber keep pointing me to $65 being my ideal entry point for a 14% IRR I've been adding lately. Yeah, that price with that percentage sounds like that could make sense depending on the assumptions you have there, but that's kind of in a logical ballpark range. Very cool build, love that. Hey, you have Roper tool too? Yep. That is one of the new builds I've been finding too. How much effort did you put into that? It looks phenomenal. Yeah, I have not put a ton of effort into Roper, and you see here it's on the ones that I want to update with the new details I got from the pricing tools and stuff. So I'll probably do that one here today. But I did kind of look at Roper initially. It definitely depends on what kind of assumptions you put in there, but it's definitely been interesting to watch that one drop like a rock. I definitely think there's a lot to like about the Roper story kind of mid-term. Whether or not it's super good long-term, like I said, might depend on some of that research there, but they were very expensive for a long time. So it's like, don't look at this as all pure valuation gravy. A lot of it's just valuation reset, but like, yeah, it's definitely crazy. Definitely crazy decline. If you're they're believed to be a very strong player in automation broadly, which I definitely think is a strong theme to pay attention to. I'm not going to pretend to have a super close understanding of all the different mechanics of their business, but it's definitely one that I would like to do a lot more work to have a better understanding of. But yeah, at first glance, I think the assumptions look pretty good. I think the assumptions here aren't the strongest either. So like I said, I'm probably going to maybe redo the numbers here this afternoon. They're one of these orange ones are after all. Which are on my essentially immediate to-do list. But we'll see. Yeah, they look like they could be kind of potentially attractive. One of the other ones, also just to kind of like call it out, I was talking about oil. I sort of called the bottom on oil a little bit there in terms of like other ones. I can't remember like what day it was, but it was like right here. Not that the oil has skyrocketed per se, but I did sort of call the bottom a little bit on oil, and some of the players that I had talked about have done reasonably well since then, like BP. Has done decently well. C&Q has done reasonably well since then. which were two of the players that I had talked about back then. So not to toot my own horn a little bit on that one, but that one worked out pretty well. I am trying to rework the numbers on some of those players as well. And BP, like I looked at a little bit last night, and I still think it's not necessarily too bad looking even after that move. But it would be interesting to see if oil pulled back even further, because like oil itself is kind of an interesting dynamic. On one hand, like I said, like I was making the argument that like now or back then was the time to really be looking at oil plays, because it's just here's when you want to be looking at it, not when it's above $75 a barrel. Like when it's 60 or so or even below is when you want to start looking at it. But at the same time, there's a lot of reasons and arguments you can be made that supply is going to continue to go on for oil for in a more steady basis over the next year or two. But sometimes even that itself, that narrative that the supply is going to come online is the trick. So sometimes you want to buy even when that's the narrative, because it's when that narrative gets broken that the price starts to react. So I don't know. We'll see. Like I said, I haven't looked super closely at oil. In some of the larger family portfolios, I did take some positions in BP and CNQ, but not for my personal portfolio. I didn't. So in a sense, I had gone long them a little bit, but only moderately so. But yeah, energy as a whole has absolutely been ripping, definitely, like the whole energy sector completely. And by the way, energy is some of those sectors that is quite hot on my rotational strategy as well. Both the large cap energy and the small cap energy ETFs have been running hot and are in there, are in the rotational strategy in the last week, and I don't believe I'm selling them going into this week. So yeah, definitely wanting to look at more energy players. And then with that in mind, also down here, I have DNOW, DNOW is a company I've been looking at a little bit right here, which right here, it doesn't show much upside, but there's very conservative assumptions, I would say, on this valuation currently, because I've been kind of experimenting with this. But DNOW is oil and energy service equipment supplier, and they recently completed a merger with MRC Global, where they're expected to have a pretty significant increase in their revenues and their earnings. Here, go over to their ticker page. Let's see. Like I was screening through some energy companies and came across this one because they have like 92% growth in revenues expected this year in 2026, with like 20% CAGR of earnings expected for like the next 3 years for EPS. And that was kind of the thing that really pulled it to my attention, was it really kind of screened through on that basis alone. But part of that has to do with the cyclicality of its business. It is an equipment supplier in the energy space, and so there's probably going to be like lack of supply for those types of services now, and so that's why they're really hot right now. And then that merger is also a huge part of that revenue growth story right there. But looking at some of the numbers, it looks to me like the market's not really assigning much terminal value to the company, and so it feels to me like that merger is highly underappreciated. It's done a little well here in like the last month or so. Yeah, because like I said, like that's why it shows not much upside on the value that I had on the watch list. But I know that a lot of the assumptions I had specifically around like the expected return and terminal multiple were very, very conservative on this. And also the revenue assumptions too. I basically assumed that like that it is a super cyclical business, and I assumed that basically the revenues themselves collapse down. Like here, if I just go and show you exactly what I mean. Like I have them grow up to the expected revenues that ticker shows in the analyst estimate, but then I have them collapse like more than 50% of the revenues down over the next like 5 to 10 years, so that by 10 years from now they're back to basically where they were before the revenue boost that they're going to have here in 2026. So essentially, I have them go basically full circle on their revenues over a 10-year period, and have their terminal multiple and their margins kind of largely do the same thing. And that's how I end up with this kind of fair value estimate. So basically, if you can assume that anything stronger than that happens in the cycle, like if their cycle, if the positive part of their cycle lasts more than basically like 3 years, which I think there's good arguments to be made that it could, then this stock has got to be underpriced. Like the terminal multiple being applied to it has got to be underpriced, or the merger between them and MRC Global has got to be underappreciated. That's basically kind of the what it looks like to me. Like I said, I haven't done like a super deep dive on all the numbers on this yet. I've just done some basic estimates of it and put it in the watch list. But it was definitely one that I found very interesting in the energy space. And I mean, it's technically classified as an industrial, technically I believe, but it's like an energy industrial. So um, kind of interesting. Kind of interesting. Oh yeah, yeah. BR Jeff, that you had mentioned that one as well. That's how this one ended up on this list as well, which has continued to crater ever since. So like you brought it up in the Discord a little bit ago, and then I did some basic evaluation work on it, which I thought it looked kind of interesting then, but it's only continued to go down even further, like a ton since then. So like looking at here, it's showing like 50% of upside on this, and I think I'm trying to remember. I might have been using somewhat of generous assumptions on part of it because I feel like when I first looked at it, it didn't look that attractive, and then it just cratered down enough that in like short order that it suddenly became more interesting. Oh, I'm looking at the wrong one. Did I click the wrong one? I clicked the wrong one. Is this the wrong link that's connected to it? Why is it? Hold on a minute. Hold on. But anyway, the point is like, yeah, it's been interesting to watch. You brought that one up in the Discord like a handful of weeks ago, a month ago or something like that. But in that time, it's already come down a ton. It's just like, wow, this thing's fallen like a rock. Which I mean, it's in a very cyclical. If I remember, because it wasn't this one. Oh no, Bellring. I mean, this might be a different one that I was thinking of. Actually, now that I'm looking at it, I was thinking this one was. Oh, I think I was confusing this one with Dorm, which was one of the other ones you had listed in that like same list you had put in the Discord of like 4 or 5 different ones. Um, but yeah, I was looking at that list you had sent though. I did take a look at that list. Uh, am I using Gemini or an equivalent to do any investigative research or to add efficiencies when you're working? I haven't used Gemini a ton. I really have been meaning to experiment more with Gemini because it does seem like the market is largely kind of coalescing more and more around that one as a favorite over the last handful of months. For a while there, it definitely seemed like the broader market in terms of like people using different tools were kind of floating around like every couple of weeks a little bit in terms of which one was ahead, but it seems like Gemini's been kind of like somewhat locking into a leading position. So it feels like maybe I should give Gemini more attention. I use Copilot a decent bit, and that's just because my work has a licensed version of Copilot, and so I use Copilot a ton at work, and so I've kind of just gotten in the habit of using that one, but not because I think that one's like super good or anything. And the licensed one that I use at work is definitely way better than just the free one that I use at home. But I should just get into the habit of trying to use Gemini as the free one. And actually, like what I need to do is actually be just stop being such a cheapskate and hawk over for a licensed version of them a little bit and just experiment that way too. But in terms of like how I use them, uh, I mean, I don't do anything super deep in terms of investigative research with them, but I use LLMs for a variety of different types of thought experiments. Like I definitely use them for like all sorts of types of like what have previously been Googling. But the point is, I guess you could say like you can kind of take Googling to the next step where in what I would have done Googling, which is that you might have had follow-up searches, right? And then you might have clicked on links, and then you might have like done a little bit of like a little thinking through some sort of brainstorming process while you were doing some Googling. And I guess in a sense, what I would say is like I would kind of analogize that to how I use LLMs, where it's like I definitely like start with like maybe an initial thought, and then based off of what the LLM returns to me, I give follow-up questions, and then that often goes into like a somewhat analytical kind of approach where I will be asking it to do some basic calculations and maybe put a table together of some information, and I'll be like kind of like coalescing stuff together with the LLM. But it's all kept usually still at a very low level. It's either very surface level information or calculations that I'm asking it to do, or if it's more complex stuff, it's only on like things where I'm just am worried about the thought experiment. The actual calculation itself doesn't matter that much, right? Like it matters that the calculation is done well to the results of my thought experiment, but I'm not going to like take the calculated number and then go do something with it. I'm just asking it to do some calculations for me. So like if I want to know like what the per capita something something or other of some data set was in some specific area for these years of this industry back then, I might ask an LLM a series of questions to try to get me to an answer for that. But then I'm not going to go rely on that information anywhere. I mostly just use it for thought experiments. But I do use them all the time for that kind of thing. I probably like every day, I use LLMs for that kind of thing. So I do find LLMs very, very useful. I definitely would say it's not like, there are some people out there that are like, oh my God, these are the most revolutionary things ever. And then there's other people out there that do kind of try to like poo-poo them as though they're just search and there's really nothing else to them other than search. And like I definitely find some very, very significant uses out of them. But I'm very hesitant to trust them with anything to a super serious degree. But like in terms of doing industry research, I ask LLMs all the time what the size of an industry is, or if it can tell me what the size of an industry was for each year of the last 10 to 15 years or something like that. I ask LLMs questions like that all the time, but the types of answers I get is varied. Like for sometimes it can give me very good, straightforward answers for those types of things, and other times it's like pulling teeth to get LLMs to really give you answers to those kinds of questions. So it can really vary in terms of using it for like investigation stuff about like how well it works out. Jeff's answers to that how he's been using them. He's been using them to validate assumptions, telling it to act as a senior analyst or a forensic analyst. It picks up on a ton of stuff I missed, and I use it to rank tier many stocks to focus on next. Yeah, exactly. I'm making my own numbers, using it to suggest some tickers for my own analysis, comparing notes. It's really nice to have an intelligent conversation with. Yeah, and that's sort of how I like to think of it as. It's like and having a semi-intelligent conversation. It's like it takes, like I said, analogizing it with search. It's like the ability to kind of do the search thing, but turn it into a kind of call and response, a sort of like a multi-step process where it's give and take, back and forth with that searching because you're having a conversation with the bot itself. And sometimes it's frustrating because it'll get very far with a thought, and sometimes it feels like it completely loses that thought, and it can be a little frustrating. Like I said, sometimes it's very, very impressive what you can get them to do. And then other times it's like very, very unimpressive. So it can definitely vary a lot how useful they are. But like I said, in terms of just like as a brainstorming tool, I use them all the time. But the output of all that brainstorming, I don't use to a very significant degree. But okay, I think that's pretty much it for today, though. We talked about pretty much everything that I had planned to talk about for the most part. Had couple interesting little side conversations there. Glad that you were able to join me today here, Jeff. I definitely was kind of initially thinking it being a Monday. I mean, I know it's President's Day, so a lot of people are off, but it's still a Monday. So I definitely thought that this was going to be definitely a quieter stream. But so at least I had you. That's cool. But yeah, so going to be enjoying the next couple of weeks. We'll hopefully have a stream in a couple of weeks' time. Hopefully, I will have updated, like I said, all these valuations that are highlighted orange here, as well as any of the ones that have earnings coming up here in the near future. Please give me suggestions in the comments below, in the Discord of other tickers to look at. I do have a small handful of tickers people have suggested to me over the last couple of weeks that I'm hoping to look at some more. And then, I'm continuing to do all sorts of other side research on a bunch of other stuff. So catch you all next time. All right. Bye.